Welcome to the Three Edge Week in Review for the week of August 22nd. I'm Fritz Folts, the Chief Investment Strategist here at Three Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at Three Edge Asset Management. Today, Steve and I will be discussing whether current circumstances, including the highest rate of inflation in 40 years, could mean the end of what is referred to on Wall Street as the Fed put. But first, a brief look at the activity in the global markets this past week. And this was a week in which it seemed that the only thing that mattered to investors was Fed Chair Powell's speech to the annual Jackson Hole Symposium. Investors were hyper-focused on whether Powell would strike a hawkish or a dovish tone about the future direction of monetary policy. Then on Friday morning, Fed Chair Powell delivered what was a brief and measured speech in which he certainly seemed to err on the side of sounding more hawkish than dovish. And he seemed intent on making sure that everyone understands that the Fed remains committed to bringing inflation down to its target rate of 2%, is likely to raise interest rates further, and may need to keep rates elevated for some time in order to bring inflation down. Powell also pushed back against any idea that the Fed would soon reverse course or pivot. In fact, he stated that, quote, the historical record cautions strongly against prematurely loosening policy. So, Steve, let's get started, and we could keep our attention focused on the Federal Reserve, and let's discuss whether the era of the Fed put is, in fact, over. And perhaps a good place to start would be just a brief description of what exactly the Fed put is. And then perhaps an example of the Fed put could be the description of the Fed responding to the onset of the global pandemic in 2020. And lastly, I think it would be helpful if you could explain just how it is that the Fed can actually create money out of thin air.
Well, Fritz, the idea behind the Fed put is that whenever the stock market has a tantrum, the Fed will always come to the rescue and protect your downside. It's like investors have a built-in put option, meaning that they don't have to worry about the downside because the Fed always comes to the rescue.
Mhm.
So this all began with Chairman Greenspan. When he was newly appointed, we had the crash of 1987, and it was rumored that he went into the derivatives market to try to stabilize the S&P 500 index at that time. And that was a precursor to what we call the era of the Fed put. That began in earnest in 1998 when we had a confluence of events. We had the Asian currency crisis, the Russian debt default, the hedge fund long-term capital management that blew up. We had the worry about computers freezing up. They called it Y2K in the year 2000. And he created a lot of stimulus that helped rescue the stock market that had a big correction in 1998 and did so much that some people say it was behind the tech stock bubble that got overinflated and burst in March of 2000. He was followed by Chairman Bernanke, who then continued the tradition of the Fed put with massive rescue plan coming out of the global financial crisis 2008. Chair Yellen followed Bernanke and continued with rounds of quantitative easing. And then Chair Powell, when he was newly appointed, despite the fact that he announced he would no longer accommodate easy monetary policies, he would bring monetary policy back to normal, stop money printing, raise rates. He abandoned that 3 short months later when we had a garden variety correction. And then, of course, in the pandemic, created more stimulus than the Fed has ever seen. So you ask, well, how does the Fed put work? And people call it money printing. Well, how does that all happen? The Fed literally creates reserves out of thin air. They go on their computer, and by clicking their mouse, they create these reserves. Then they use these reserves to buy real securities from the banking system, largely treasury bonds, notes, and bills, also including with that mortgage bonds. And then in an extreme case, like after the pandemic, they actually bought ETFs that own junk bonds and also muni bonds, which is really quite an extreme.
Right.
And when they do that, the money going into these securities inflates their asset values. And coupled with the fiscal stimulus we had after the pandemic, the money got into the real economy. It inflated consumer prices for goods and services. And as a consequence, we had the highest consumer price inflation rate in the last 40 years. So if you look at the chart, you'll see how, in fact, the Fed has printed more in the last 2 years, since the pandemic, than in the previous 107 years combined, which is really extraordinary. But even more extraordinary is that the Fed now has said enough is enough. They're going to reverse the quantitative easing, which is the money printing. They're now introducing quantitative tightening. It's going to come into being in earnest in September. It's just started, but in September it really starts to hit in a greater way. And so we shall see what happens when, if they stick to their plan, we have the greatest quantitative tightening that the Fed has ever seen.
Wow. All right, good. So now I actually have a follow-up question for you. And so we have the Fed doing this money printing, the stimulus. And I guess my question would be, so in that process, have they actually created wealth by printing money, or is that just an illusion?
So let's take a look, as an example, at the US stock market over what we're calling the era of the Fed put. So you can see the top line in the chart. For 25 years, the stock market, although it's fluctuated, has ended up in a much higher place than where it started. Of course, US stock index, the S&P 500 index, is measured in terms of US dollars. And these are the very dollars that the Fed created over this time during many stimulus programs. So let's look instead at the bottom line, which shows the same stock market, the US stock market, over the same 25 years, but rather than in terms of US dollars, which can be printed, in terms of a currency that can't be printed. In this case, we're using gold as a currency that can't be printed. And what you see is, during this era, we see fluctuations, but we basically ended up pretty much where we started 25 years ago. So this is a good demonstration that while the Fed can boost psychology in the short term and try to arrest a panicked market, keeping up this kind of stimulus over the long term creates an illusion of wealth, not real wealth.
Very interesting. Great. And so always my final question is based on, what we've discussed here today about the so-called Fed put, and probably consistent with the Fed and Jay Powell's address to Jackson Hole, where he seemed to indicate the Fed wasn't intending to pivot from tightening monetary policy anytime soon. Based on that, how might investors think about positioning their investment portfolios at this point in time?
So based on our research, valuation is still in an overvalued state for the US market in particular. Economic factors are still largely negative. And we just got confirmation that Chairman Powell at this time is not about to reverse the tightening of monetary policy. When you put that all together, I say continued caution, stay defensive.
Excellent.
Furthermore, because inflation is now much higher than at any other time during the era of the Fed put, this puts new constraints on the Fed. And so for that reason, we say that the era may be over.
So the Fed may be in a position where, even if they wanted to, they really can't afford to, with inflation as elevated as it is, and may continue. So excellent. Thank you. That was really great explanation. That will do it for Steve and me. As a programming note, next weekend will mark the Labor Day long weekend and the end of summer. Ugh. And so we will not be recording a 3-Edge Weekend Review video, but of course we will return in September. Remember, all our videos are always available on our 3Edge YouTube channel. In addition, all our videos and written commentaries are always available on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, we wish everyone a happy and safe Labor Day holiday. Thanks for listening, and see you in September.